On the night of August 15, 1971, every one of America's most popular television programs was interrupted mid-broadcast for an important government announcement. From the Oval Office, U.S. President Richard Nixon announced a new economic policy for the nation.
I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets.
The U.S. declared it would suspend the convertibility of the dollar into gold and increase import tariffs by 10%. This decision led to the official death of the gold standard after more than 100 years of existence. Along with this, the U.S. dollar transitioned to a floating exchange rate system, which continues to this day. But what caused the gold standard to collapse? What you are seeing on the screen now is how today's international monetary system operates, where national currencies can only be exchanged with each other at a floating exchange rate. But from the early 19th century until nearly the end of the 20th century, a very different monetary system was in place. That was in 1821, when the gold standard was born. Under this system, the government would issue cash to circulate in the economy. This money could be converted back into gold whenever the holder wished. The exchange rate between national currencies was also determined through gold. For example, the British pound was pegged to gold at a rate of 6 pounds to 1 ounce of gold. Meanwhile, the French franc was valued at 30 francs for the same amount of gold. Thus, the exchange rate between the British pound and the French franc would be 1 pound to 5 francs, with gold as the fixed anchor. At that time, the gold standard provided a stable payment mechanism for international trade because exchange rates were almost always kept at a fixed level. This helped countries simplify currency exchange with each other. Furthermore, because the gold standard had the advantage of stability, the amount of money issued had to correspond to the amount of gold in the treasury. Therefore, the government's power to print more money was limited. Thanks to this, countries also built trust in each other's currencies, further strengthening international trade relations. It could be said that nothing was more logical than applying the gold standard at that time, but that was before any major incidents occurred. In 1914, the First World War broke out. This moment also marked the gradual loss of the gold standard's position, as warring nations continuously printed money for the war, led by Germany. On August 4, 1914, just 3 days after Germany declared war on Russia, the German parliament passed the so-called monetary law. Through this, the pegging of the mark to gold was abolished. This allowed Germany to print money freely. And what was recorded in the market afterward was a surge in the volume of cash put into circulation. From 13 billion marks in 1913, it rose to 60 billion marks by the end of the war. In other words, Germany freely printed money to spend on the war without anchoring the value of its currency to anything. Although not every nation printed money recklessly to cover war expenses like Germany. For instance, the United States issued bonds to raise capital from its citizens, but Germany's actions alone were enough to erode the international monetary system at the time. The United States and other belligerents later had to suspend the gold standard, either fully or partially, so as not to hinder their war investment efforts. Who would sit still while their rival was modernizing their army day by day? Germany's actions caused the gold standard to collapse in a single day in 1914. Moreover, even if Germany had not printed money recklessly, the gold standard could not have survived, because during the First World War, it had become a national weakness. This was the case for Great Britain. As the world's important financial center at the time, clients from all over the world had deposited vast assets in British banks, including clients from hostile nations. If these clients had demanded the conversion of British pounds into gold, the British economy would not only have lost wealth, but the enemies of the United Kingdom would also have benefited. It can be said that the war exposed the unsuitability of the gold standard as an international payment system because it was too rigid and had national security loopholes. But war was not the only obstacle the gold standard faced. Despite the limitations mentioned above, countries re-established the gold standard after 1918. The difference was that before World War I, countries on the gold standard had to maintain sufficient gold reserves for conversion on demand. After the war, only a few countries had significant gold reserves. Therefore, they began to restore the gold standard in a different form. It was called the Gold Exchange Standard, born out of an international conference in Italy in 1922. This system stipulated that only the US dollar and the British pound would be pegged to gold, while other currencies would be pegged to these two. By doing this, the participating countries believed that the international monetary system would be re-established as it was before the war. However, the reality was much harsher. Although the gold standard was highly stable, as we analyzed earlier, this very stability became a straitjacket around the economy when it faced difficulties. The United States during the Great Depression of 1929 is an example. The gold standard turned a minor economic weakness into the most severe depression in world history, unsurpassed even by the 2008 recession or the crisis caused by the COVID-19 pandemic. The story began in the U.S. stock market in the 1920s. During this decade, strong U.S. economic growth led to stock market speculation. The stock index of the top 30 U.S. companies increased six-fold from 63 points in August 1921 to 381 points in September 1929. This growth rate made Americans believe they could easily get rich in the financial market. And so by the end of the 1920s, from large and small banks and manufacturing companies to the majority of the population, everyone had poured their savings into stocks to make a profit. Many even mortgaged their homes for speculation. Borrowing activities took place all over the U.S. just to buy and sell stocks. By 1929, these speculative activities finally caught the attention of the U.S. Federal Reserve, the Fed. The agency believed that borrowing and pouring capital into the stock market was stifling sectors that create real value, such as commerce and industry. Therefore, they decided to raise lending interest rates. The governor of the New York Fed at the time believed that raising interest rates would make it harder for companies and consumers to borrow. The flow of money into the market would slow down. Thus, they would succeed in cooling down the speculative sentiment. However, raising interest rates had unintended consequences. The increased interest rates did indeed weaken the flow of money into the market. The rise in stock prices also stalled. This led to losses for stock investors. And on October 24, 1929, a wave of stock sell-offs took place. A record 12.9 million shares were traded on that day alone. It became a historic event known as Black Thursday. It didn't stop there. On October 29th, another wave of panic swept through. About 16 million shares were traded, causing many investors to lose everything overnight. When stock investors lost money, the banks that lent to them could not recover their capital. Even the bank's own stock investments suffered losses. As an inevitable consequence, banks with too many bad debts and poor stock investments went bankrupt in the period that followed. Specifically, about 650 banks in the U.S. went bankrupt in 1929. This number increased to over 1,300 just 1 year later. The collapse of these banks caused the savings of many Americans to evaporate and created a new consequence, a widespread wave of bank runs. Many depositors feared the possibility of their banks failing. Therefore, they demanded their deposits be returned in cash immediately. The wave of withdrawals by the public further pushed the wave of bank bankruptcies higher, while the Federal Reserve made no move to intervene. And by December 1931, the Bank of United States in New York also collapsed, unable to repay more than $200 million in savings to its customers. This was the largest single bank failure in U.S. history. Many families lost their life savings and began to worry about their ability to pay living expenses. This worry forced them to cut back on spending. Without consumption, there is no production, and without production, businesses suffer. From there, they began to lay off workers. The wave of unemployment increased and peaked in 1933, with 25.59% of American workers unemployed. The crisis in the U.S. then spread globally because trade with the world's largest economy stagnated. As a result, between 1929 and 1932, global GDP fell by about 15%. Looking back from the present, Monetarists believe that the Great Depression was originally an ordinary recession. It began with the usual panic in the stock market, but the inaction of the U.S. Federal Reserve exacerbated the economic situation, turning the recession into the Great Depression. If they had expanded the money supply and supported the banks in paying out deposits, the banks in the system would not have collapsed. The public would not have been so pessimistic, as their savings would have been guaranteed. The wave of crisis would thus have been confined to the stock market and not spread throughout the entire economy. But in the 1930s, the Fed could not expand the money supply for the banks in the system because their currency was pegged to gold. The amount of money in the market was tied to the amount of gold in the Treasury. To put it simply, the U.S. printing more money at that time was no different from single-handedly dismantling the international financial system that the country had painstakingly built. And so, the Fed passively watched an ordinary recession transform into the Great Depression. Therefore, it can be seen that the stability of the gold standard was precisely the noose that tightened around the economy in times of difficulty. The Great Depression of the 1930s only ended when the U.S. abandoned the gold standard. From 1933 to 1938, the U.S. implemented President Franklin D. Roosevelt's New Deal program. The reforms included leaving the gold standard, increasing public spending to address unemployment, and expanding the money supply to support businesses and the banking system. As a result, from June 33, although the dollar was devalued, the U.S. economy experienced the 3 most vigorous months of recovery in its history. Despite everything, the gold standard was still favored. It was resurrected in its new form from 1914 until the final nail was driven into the coffin of this monetary system. The chaos of the 1929 crisis and the Second World War created the need to establish a new international financial system. In 1944, 44 nations participated in a conference in the U.S. Here, the countries agreed to adopt a common monetary system and named it Bretton Woods. This system stipulated that the U.S. dollar was the only currency convertible to gold at a rate of $35 per ounce. Other currencies could not be directly converted to gold. Instead, if they held dollars, they could exchange them for gold from the U.S. Treasury. In addition, countries could only use gold or U.S. dollars as means of international payment. Basically, Bretton Woods was a gold standard, but one tied to the dollar. This was because after World War II, the U.S. held 75% of the world's gold. Drawing from the experience of the Great Depression and World War I, this time the new gold standard system was accompanied by a supervisory organization. It was called the International Monetary Fund, or IMF. This fund's role was to monitor the monetary policies of the participating countries. Accordingly, the exchange rate difference between other currencies and the U.S. dollar was only allowed to fluctuate within a range of -1% to +1%. This rule ensured that member countries did not print money massively as they did during World War I. Additionally, to avoid repeating the rigidity of the gold standard, countries would contribute a certain amount of money to the IMF, and this money would be used to support member countries in preventing economic shocks. After its establishment, the Bretton Woods system worked quite well for nearly 30 years. However, once again, it collapsed at the hands of the Americans. The U.S. had enormous defense spending needs during the war, most notably the war in Vietnam. Due to the colossal defense spending needs, the U.S. repeated the actions of Germany during World War I. They printed a lot of money without the established gold reserve ratio. This reckless printing created a situation where the amount of dollars circulating in the world far exceeded the amount of gold the United States could convert. This caused resentment among countries under this currency. While the U.S. was free to print money, other countries had to adhere to the regulations. French President Charles de Gaulle then loudly criticized the Bretton Woods system. He also called on member countries to return to the classical gold standard. More drastically, in 1965, France, along with Spain, converted a large amount of dollars into gold in a challenge to the Bretton Woods system. As a result, U.S. gold reserves fell from 20,000 tons in 1950 to 9,000 tons in 1971. Furthermore, from 1960, Japan expanded their money supply, causing the yen to depreciate sharply. Meanwhile, the US dollar was pegged at $35 an ounce, making American goods expensive on the international market. Thanks to this advantage, Japanese goods flooded the US market, causing hardship for American manufacturers on their own soil. Finally, to cover the trade deficit and to print money freely for the war, the United States once again suspended the convertibility of the dollar to gold and allowed the dollar to float. That was the end of the gold standard system. Once again, the Americans killed the system of pegging the dollar to gold, and once again, the gold standard collapsed due to its own rigidity. It can be seen that throughout its more than 100 years of existence, the gold standard collapsed many times, only to be reestablished and adjusted to suit the times. But the very rigidity of this system made its survival impossible. When President Nixon announced the suspension of dollar-to-gold convertibility and that the dollar would float, countries like Britain and France followed the U.S., creating the monetary system we see today. The gold standard, though stable, could not support the economy whenever it ran into trouble and was also prone to collapse due to conflicts in contradictory monetary policies of various countries. These reasons made it unable to compete with the flexibility of the floating exchange rate system. Therefore, its collapse was an inevitable part of the world's financial progression and development. Now, with the formation of the crypto financial system, we are witnessing the evolution of a new payment system, faster, more reliable, and decentralized. It will not be easy or quick. However, we have already seen its solid foundation based on blockchain technology. Bitcoin failed to become a global means of payment. The names that appeared after it have not had any successful projects. And now, Pi Network is gradually moving towards that goal. The goal of becoming a means of payment for everyone. The opportunity is there, the foundation is there, but to succeed, it will take much more time. Follow the P from Us channel now so that together we can witness the formation of the world's new financial system.